But then I learned about this product called the First Lien HELOC, and it completely blew me away with how people are using it and the outcomes that they're receiving when it works for them. Because people are able to pay off their homes extremely quickly. I'm talking 5 to 10 years, and because you're paying it off so fast, they're saving tens to hundreds of thousands of dollars in interest costs, and no one knows about it.
This is my time. Hi, I'm Kyle Stephenson, and you're listening to the Assets and Orthopedics Podcast. In this forum, we hope to educate medical students, residents, physicians, and other high-income professionals on the power of investing, especially in real estate assets and syndications. We want to help providers gain financial intelligence with the hope of earning financial freedom. Please listen and learn so you can spend more time doing what you love with who you love. Enjoy the podcast. Hello and welcome to the Assets and Orthopedics Podcast. This is your host, Kyle Stephenson. This next guest is going to educate us all on something that is probably a new concept to most of you. Have you ever heard of the term velocity banking? Well, I'm excited to introduce you all to our next guest who's going to explain that to us and much, much more. Anthony Rushing, welcome to the show, sir.
Thank you, Kyle. I really appreciate it. I'm excited to chat with you and like you said, introduce maybe something that people are not aware of in a way that hopefully they can understand and provide some value to them as well. I'm really excited to be here and chat with you.
Absolutely. Thank you very much, sir. So let me give a quick introduction of you and then have you fill in the gaps, and then we'll start on the topic at hand. So Anthony is a seasoned loan originator at First Savings Bank, specializing in the advocacy, education, and implementation of the First Lien HELOC, home equity line of credit strategy. With a focus on accelerated mortgage payoff and financial empowerment, Anthony has dedicated his career to helping clients leverage their home equity to achieve financial freedom. He provides insights into advanced strategies like velocity banking, which we'll get into, guiding clients on effective debt management and wealth building techniques. He holds a master's degree in education leadership from LSU. Go Tigers.
Go Tigers.
Underscoring his commitment to guiding clients and fostering informed decision-making in the realm of finance. All right, what do you have to add to that?
Well, first, anytime anyone says Go Tigers, I have to follow up with Go Tigers really quickly. So I didn't mean to catch you off guard with that. But yeah, so basically what we do, what I do is I specialize in first position HELOCs and how people leverage them. My journey here is rather diverse. I quit college halfway through to join a rock band, play the violin and fiddle. So was a fiddle player and toured for 6 years, and I loved it. It was really great. Challenge that I found was that I didn't really know how my work, my toil, my effort was helping improve people's lives. And that was a big challenge for me, sort of an existential crisis, we'll call it, in this world where everyone thinks that not everyone, but a lot of people think they want to be on that stage. We got to play some really cool places, but that was a big challenge for me. And not that music doesn't, right? I've been surrounded by music my whole life, and it has enhanced my life in ways that other things haven't. So the reality is the value's there. I just couldn't see it. I couldn't touch it. And that was hard for me. So went back to school, went back to college, finished up, and then learned about this program called Teach for America that focuses on really recruiting non-education graduates who are somewhat, leadership-oriented, idealists, we'll call it, and want to make a difference in the world. And they recruit you and basically supercharge you to become an extremely effective educator, a teacher. So I went into the classroom and taught for 6-7 years, 5 of those in Baker, Louisiana, which is the second to lowest performing district in Louisiana, which is probably close to the States, right? But helped to, grow the school from an F to a B minus within, 3 or 4 years, which is amazing. And loved that work and the role that I had, because I knew that my efforts, my blood, sweat, and tears, I did probably cut myself, so I did bleed. I can tell you there were some tears there. As much as I don't want to admit it, it was really, really tough. And obviously you're sweating too. But that my work and effort and purpose at that point was actually improving people's lives if I did a good job with it. And so that was a big a big satisfaction effect for me in terms of that particular role that I had. Through that, I got my master's at education leadership at LSU, and that then halfway through grad school, though, my wife and I had twins. Then when we moved to Nashville the year after I graduated, they were one, and we didn't have family or help here, and so that was really challenging. And I was in an extremely high performing school at that point, and just struggled with the balance between being a dad and the new responsibilities of what that looked like. I have two kids that are colicky, and we don't have help. So that was challenging. And then there was the financial aspect too, in terms of what I wanted for the family, right? And it was really hard for me to backwards plan into what I wanted to accomplish for the family with what education provides. Made a move at that point into the mortgage business, and I was actually playing in a band, a bluegrass band.
In Nashville?
In Nashville, yeah. It was a lot of fun, and a different kind of role. It's more improv in terms of playing the same thing over and over and over. So I really enjoyed that. It was a good outlet. But the mandolin player was a high performing, high volume producing loan originator, and so he kind of brought me on and taught me the business. But I remember when I started, my best friend, who was also the keyboard player for the band that we played in, but my best friend called and said, "Hey, he knows me pretty well," and he's like, "Hey, Anthony, that fact that the satisfaction that you get from being able to help people every day, right? And you really that means a lot to you." And I said, "Yeah, it does." And he said, he's in construction management, commercial construction. So he said, "So when you enter into this new role, in it's going to be really hard for you to see that." And he's like, "I just want to prepare you for that, because it's not going to be obvious, right? It's not, and he was right. Being a loan officer doing traditional mortgages is great. And you get to help people with the transaction, and you get to provide the lowest rate if you do, or a great experience. But you're not really changing anything. You
have no control.
No control, and you're not moving the needle in terms of improving people's lives, other than giving them a great experience or providing a low rate."
Sure.
So I did that with the understanding that I was sacrificing that desire, we'll call it, for the financial future of my family, which that became the priority at that point. And I was okay with that. But then I learned about this product called the First Lien HELOC, and it completely blew me away with how people are using it and the outcomes that they're receiving when it works for them. Because people are able to pay off their homes extremely quickly. I'm talking 5 to 10 years, and because you're paying it off so fast, they're saving tens to hundreds of thousands of dollars in interest costs, and no one knows about it. So here I learned about this thing, right, where if I'm good at advocating for it, if I'm good at teaching people about how it works and introducing a concept and finding and talking to the right subset of people, I have the ability to feed my family in the way that I would hope for, right? Or that my goals, in terms of that piece of it. But I also get to live a life where, by talking with people and introducing this concept and teaching it to them, when it works, I get to know that my work and my effort and my purpose, right, as a person, is one that is still able to improve people's lives and move the needle and have an impact. Which it's kind of like, after all those experiences, I taught fourth grade math, right? This isn't any harder than fourth grade math. So I think, I was pretty good at that, right? So, and I want to know that my work helps people. And so it seems like it all kind of came together with this. And so that, if my excitement doesn't come out, it should, because it was just mind-boggling to me at how much great of an alignment there was with this, but also how much this can help people improve their financial futures in a way that other things I'm just not aware of. And so, and it's a new concept that, all I have to do is tell people about it, and then we can find out if it works,
Yep. No, that's great. A couple things on that. The best day of your life was the day you were born. Second best day is the day you find out why.
Yeah.
It's finding your purpose. And it sounds like you found yours, which is awesome. And the other thing I would say, you mentioned being a fiddle player, which is awesome. We go to Zach Brown band concerts, and the coolest part is this fiddle player.
Yeah, he's great.
The guy steals the show. Yeah. And Louisiana, there's a ton of that, right? All that bluegrass.
Well, I will claim being a fiddle player in any city in the United States, except for Nashville and maybe New York, because when you say you're a fiddle player, it means something here, and I'm not that.
Okay.
Here, it's like, do you play? I play the fiddle, right? But I won't name being a Nashville cat, a Nashville fiddle player, because that means something else, which I'm not. But any other city, but yeah, I grew up playing violin and picked it up later on when I joined the band, and I love it. It's great.
Good for you, man. And then the other thing I'll say though, with music, you're saying, it wasn't tangible for you to see people's the impact you made on people. I made this comment today. Literally, I was in the operating room and we were just talking about, my nurse knows that I love country music from the 90s, early 2000s. So she's always playing that, and it just is nostalgic for me, bringing me back to the days of when I was growing up. And, I said, once I hit puberty, I basically had no emotion as a guy. Like I couldn't cry at all. Right. And then when I had kids, things changed a little bit. But in between that time, I could listen to a country song and that may bring me to tears. There's ways that music can pull out certain emotions in you, even if you're not an emotional person. So I will say that's my 2 cents on music and how it does make a huge impact on people.
And I completely agree with you. And I've got music playing pretty much all the time. And it's one of those things where I'll find certain songs that bring me to a certain place. And I love that about it, because when it's done well, like if there's a certain run or a melody, or, if you've got a good like funk beat, or if you've got a great, like a song that helps bring you to another place, right? From an experience standpoint, it absolutely has a huge value. I think you hit it well, where it was like, it just wasn't tangible. I couldn't touch it, right? I couldn't see it. When I started to realize that, I think my reaction was one that was almost a negative one, where it reinforced those negative thoughts, right? In terms of it not being fulfilling for me in that way, where a lot of that may not have been true. Well, I know it wasn't true in terms of it not improving or helping other people's lives. But I think for me, it was such a challenge that I couldn't see it. And we had fans and they were like, oh, this is great, But in terms of again, improving people's lives and my work with with those songs, improving people's lives in a way that was moving the needle and changing things, I couldn't see that. And I couldn't recognize that because it is so abstract.
For sure. And it's different for everybody too, right?
Absolutely.
I mean, there are tons of musicians that we all look at their lives and we're like, man, that's the coolest thing ever. Oh my gosh. And actually I had a 10-minute conversation with Dierks Bentley.
Oh, really?
Yeah. I was in Charleston. My brother-in-law got us behind the backstage passes. Awesome. Got to meet his touring manager. And then we hung out in the room afterwards. He came back to this room and I happened to be the first one by the door. So he comes and talks to my wife and my sister and I, and we were just chatting. And, I'm into cycling. He's into cycling. He's into working out. And so we were just talking about different things. And then we were like, so how do you do it drinking 300 days a year, basically going on stage and putting a party on? Like, how do you do it? And he's like, honestly, I quit drinking years ago.
Yeah.
He goes, that's all for show. He goes, because the life on the road can be extremely lonely and isolating when you're drinking a ton. And when you're drinking, it makes it much worse, So I thought that was pretty cool and fascinating.
You're right. For us, we were in a van for a while, and then we had a bus after that. But we weren't big enough where we had to be completely isolated from the crowd. So we ended up, the different places we played, we ended up having sort of a small network of people that we knew and would hang out with at each place. But at the same time, the reality with that is when you're in entertainment, you're working when everyone else is off. And so things like birthdays and weddings and funerals and important events and just your friends hanging out, like you miss that. And so I was, again, pretty young, but like we lived in this complex. You had to like buzz in, right? And my college buddies would go out, and the number that you would buzz to, that you had to hit the number to open the gate, right, was mine. Well, they would go out and then be drinking and then come back and leave the best messages on my voicemail while I'm playing music, because they're trying to get back into the complex, which was great, but it was also kind of bittersweet in a way, because I wasn't with them, right? And I appreciated and loved the fact that they still thought about me enough to like leave the message there, right? But at the same time, that was a challenge too. And I think that, for people who are able to live the road life and tour we were doing upwards of 160 to 180 dates a year. So we were gone a lot, and you have to own it and not just love it, but it has to be who you are, in a way that those things are sacrifices you're willing to make for music. And I think that was another piece to it too, which was that it's those other aspects of life are a priority to me. And, I didn't grow up wanting to be a rock star. I kind of fell into it, and it was a great experience, and I'm grateful for it. And I'd do it all over again if I had to. But at the same time, at the core, I don't think it was me, because I value a lot of those other things in life more than, being able to play music every night and things with that notoriety and all that,
No, good for you, man. It adds layers, it adds depth, to you, it adds character. So that's cool. Yeah, no, it's great. And you thought you were coming on to talk about First Lien HELOC.
Yeah, it's all right. It's all right. Well, I'm sure we'll end up getting there, but no, it's okay. Yeah.
Well, let's get to the meat of it. Let's go. This is probably the first time a lot of these listeners may have even heard of this term, velocity banking. So do you mind just going through like a kind of a simple explanation of what First Lien HELOC is and how it differs from traditional mortgage?
Yes. So a First Lien HELOC is a mortgage product. So if by definition you've got a mortgage is a loan that's secured by real estate. So that is a mortgage product. The way that we usually talk about when we say the word mortgage, what most people think of is an amortized mortgage, which means it's got a set term and a pay down schedule, where you at a fixed payment every month, and you give the most amount of the money to the bank at the beginning of the amortized mortgage, and the least amount goes to you. And then after about 14 or 15 years, that flips, and then you end up giving yourself more money than you give the bank. And after that term is done, then it's guaranteed to be paid off. That's usually what people think of when we say the word mortgage. What we do is we offer and specialize in a mortgage product that works differently than that. It's a first position HELOC. Now, people also know the word HELOC. So when people think of the word HELOC, they usually think of an extension of credit on top of your mortgage. So you keep your mortgage, we're going to get a HELOC on top of that, which means now I can access some of the equity in the home to do some things with, right? So I can pay for my kids' college with it, or I buy an RV, or we buy a car, or we just want to have an emergency fund sitting there, right? So that's usually what people think of when they think of the word HELOC. Ours is different than that too. Ours is in the first lien position, which the lien position is basically who gets paid off first if someone were to default. And so the first lien position HELOC means that we have to get paid off first, which means we have to get rid of anything that's already in the first lien position. So essentially what the first lien HELOC does, if you already have a mortgage, is it's a refinance. It pays off your current mortgage, and you end up with one big HELOC. So for instance, if you have a $400,000 home, right, and your HELOC can go to, let's say, 80%, right? So that would give you a max limit for this HELOC of $320, right? So let's just say your mortgage balance was $200 at that point, right? So we paid off a $200,000 mortgage balance, but I have a limit with this first lien HELOC up to $320, which means I owe $200 on this HELOC. That's the mortgage balance. But then I also have access up to that limit, which is an additional $120,000 as cushion or emergency fund at the most basic level. So it's one big one big mortgage product, right? One big HELOC that comes and refinances you out of your mortgage, or just essentially replaces your mortgage into one big HELOC. And so that's what we specialize in. That's what we offer. And all in all, the fact that it's a product and the fact that we offer that particular product, that isn't really what makes it that special. It is what it is, right? And we, the thing that really, really attracted me to this was that because it works differently, because it follows a different rule set, we'll call it, than an amortized mortgage, that means you can treat it differently. And when you do that, you can achieve different goals or different outcomes. And so what we've done is we know how this loan functions so well, we'll call it, that we know how to maximize the structure of this loan, and we teach people how to leverage this product to pay off their homes really, really quickly and to save tons of money, tons of dollars in overall interest. That's where this velocity banking term that you brought up earlier, that's where that kind of comes.
Yep. That's great. So when we think of a traditional HELOC, that's really a second position or second lien. Is that correct?
Yep, that's right. That's right. Because your mortgage, if someone were to default, the mortgage would get paid off first, and whatever residual there is after that mortgage is paid off would then go to the second position HELOC. Correct.
Okay. And then just a couple stats, and I looked this up just to clarify, but as I get more into like the infinite banking concept, there's a lot of similarities to the mindsets of this velocity banking with infinite banking. But I've learned that whole amortization schedule, we all 30-year mortgage is pretty typical, right? And we're all kind of just led to believe that that's the best way to go. And then you realize, it's front loaded heavy with the interest payments. And so I looked this up, and it's really like 60 to maybe 80% of your interest is being paid in the first 8 to 10 years.
So in the first 14 years, I did a podcast on this yesterday, actually, and I had because I was on one before. I was basically bashing the amortization schedule, saying that it's really expensive. It's not to the banks. It's not to the consumer's interest. It's to the bank's interest, right? And I made some assumptions that that's a given. And then the comments that I read afterwards, they were like, why is this, how is that? Why is it not that great? Why is it, so I'd love to have you talk about that too. So I did a full, another one on that, but essentially, with a 4.5% interest rate, the bank and 14.8 years, I think, that's where it flips, where you all of a sudden are giving yourself more than you're giving more of your payment to yourself than you are giving to the bank, right? The bank has received 81% of the interest they're going to receive for the life of the loan at 14.8 years. And so at the beginning of the loan, the delta, we'll call it, the difference between the amount you're giving them and the amount that you're giving yourself. And when I say you're giving them money and yourself, I'm talking about interest cost to the bank and the amount that's going toward your principal, right? Is like the first payment, they receive 74% of the first month's payment.
Is interest.
You receive this interest and you get the rest. And people talk about the overall cost of the amortized mortgage, but most people don't make it to the end until they're 75 or 80. And so you end up going back to the worst position possible for yourself and giving the bank the best position possible every time you refinance into another amortized mortgage. So I was saying things like, we all know that amortized mortgage is so bad, right? And to kind of lead into the fact that there's another option.
Yep.
So anyway, talked about, that first lien HELOC numbers as well.
Yeah. Well, so you and I went through a possible scenario. We are in the process of building a house, and I would love to use this process because, and we'll talk about this too, but overall to say we compared a 30-year mortgage to this first lien HELOC, and the amount of interest difference between the two is insane. The number of years that you pay it off is insane. So $1.5 million home, 30-year was over $1 million interest.
At what rate?
4.5.
Mm-hmm.
Well, you only did like a 25-year term just because we were talking about getting that down to 1.5. So really, it's, in 30 years, it would be like probably 1.2 million, we'll call it, at a 4.5% rate. And then so that's 30 years. Then the first lien HELOC, the interest payments were $430,000. And that is in 6.42 years, you'd pay that off.
And what was the rate on the HELOC that we used?
8.1.
So you're telling me that a higher interest home loan was a lot less expensive than a lower rate home loan?
Yes. Higher rate.
Higher rate is better, right?
Oh, yeah. They're like by like half.
Right. And that's the first thing people usually go to, right? Because what we tend to do is we use the relationship and the understanding of how home loans work and what our understanding of that, which is all rooted in amortized mortgages. And so we use that and we apply that here too and assume that, higher rate means more expensive, lower rate means less expensive, no matter what. Well, that's not true because there are other factors that drive to the overall cost, the total interest paid, the TIP. And so rate is one, but the other two aren't worth analyzing with an amortized mortgage because they're set by the schedule. One is the amount of time that you're paying interest. If you can pay off your home in a really short period of time, you can trump the fact that you have a higher rate. Right? The example I like to use is, would you rather pay 12% for the same balance, right? 12% for 1 year on a 1-year loan, or would you rather pay 3% for 30 years? Right? And mathematically, right, you'd choose. And what people say, because they don't want to say what I'm really trying to push for, but they'll say, "Oh, I'd choose the 1-year one." I'm like, no. Would you choose the higher rate or would you choose the lower rate? And they struggle to say it because we're not supposed to say, I would choose the high rate loan, right? But in that scenario, you would. And I use extremes to help people connect with those concepts, right? Same thing with the balance, right? Would you rather pay 12% on a $1 balance or 3% on $1 million, right? Super extreme, but it makes it easy. Well, I'd choose the low balance one. What about the rate? I choose the high rate one, right? And so with the first lien HELOC and the velocity banking strategy, when it works for people and when they utilize it correctly, you pay off the home really quickly. We attack the balance, right? And we attack the balance to where it creates a low balance quickly as well. So even though you have a high rate against low balance can equal lower cost too. And so this strategy is about manipulating the balance as much as you can to accomplish that goal of extreme debt payoff. And there are other things to it too, but that's usually what we lead with is, hey, look, this could be a really, really great option for you if you line up with what the strategy calls for.
And I will add, so because you mentioned the first lien HELOC in my example, real life example, first lien HELOC is 8.1%, whereas the 30-year was a 4.5%. I just changed it to a 30-year, by the way. 4.5%, we haven't seen that in a couple of years anyways. So right now it'd be like 6.5%, but I digress. Interest paid in that 30-year was 1.2, like I said. The coolest thing is the 30-year equivalent rate for the first lien HELOC is 1.75%. So it's kind of cool that you guys calculate that in.
Right. And so what Kyle's talking about is when we get an output, we put in the information, and we'll go into that in a second too, but we input the information and it gives us an output, but we're looking at an 8% rate on paper. I have a $1.5 million home loan that's going to cost me $480, right? Most people don't connect with the total interest paid. They just don't. We don't have an ingrained relationship in terms of total cost to loan amount, right? Because we don't need to with an amortized mortgage. With an amortized mortgage, we just need to know what's the rate, and I know what's good or bad, right? Well, here we add in other factors. So the ratio of your total interest paid to your initial loan amount is what's important. We focus on the dollars that people are giving the bank. And so I kept running into challenges because people are looking at an 8.1% rate, freaking out, thinking that it's bad, looking at a $480,000 cost on a $1.5 million house. And I kept losing them because I would say, look, it's going to cost you $480,000. And they say, I don't care. The rate's 8.1%. And I said, I know, but it's 480. That's good. So what we did is we calculated to what the rate would have to be, right, with a 30-year fixed, with that HELOC scenario to be true, right? So in terms of that, a $1.5 million home with whatever your cost, total interest paid, 480 cost, is equivalent to a 30-year fixed rate mortgage at that
1.75 or something.
75, right? And so we did that because I wanted to be able to show people what you're actually getting from an apples to apples comparison.
Exactly. No, that's great. And there's a certain law that talks about how it's like 10 times harder for people to unlearn something that they've learned, right? It's all of us have learned 30-year mortgage is the best way to go throughout our lives and focus on the interest rate. But in fact, here we're saying, no, it's actually the total volume of interest that you're paying. Look at that comparison. And it's actually very staggering. 480 versus 1.2. It's insane.
It's funny you say that because my experience, I still think of myself as an educator because we have to teach people about the strategy. We have to help make sure that we answer all the questions they have. When people ask a question, if I only answer that question, it won't fix the problem. We have to take a few steps back and figure out what's the root of the misunderstanding. But the way I sort of see it is the first phase of this is peeling people away from what we assume to be true first. Because now I have someone who is curious and who wants to learn. But before we do that, people just tend to be so set in their ways that they can't access this unless we sort of debunk a few assumptions that they have.
Exactly.
But in terms of the strategy, right, this velocity banking strategy, it's rooted, again, in how the loan works, right? So a first lien HELOC, there are two main ways that it's different. One has to do with money flow. The other one has to do with how it calculates the interest payment each month. So money flow wise, your mortgages, money can only flow in. Once it's there, it's locked away. Here, money can flow in and out freely, which means you can safely put every dollar that goes in, you can take back out. So you can safely put as much money, you can safely put as little, you can safely put everything you have into this to pay it down because you can take the money back out. So that's just a reality of this that we know and we leverage. The second difference has to do with how it calculates the interest payment each month. So your amortized mortgage, the way that they calculate the rate is they look at the previous month's end balance. And they use that balance on that last day of the previous month against your rate to calculate the payment. And that's the method. Your first lien the right first lien HELOC, the bank was very specific that I had to say the right first lien HELOC because I can't know if they all do it this way. But I do know that the right one for the strategy calculates the interest differently. It doesn't use the previous month's end balance. It uses what's called the average daily principal balance. So it takes an average of all of the balances throughout the month, right? So if you got 30 days, it looks at all those 30-day balances and it takes the average of all those days' balances. It uses that average balance against your rate to calculate your payment. So if you want the lowest payment, we have to create the lowest average balance, which means I got 30 days. If I want to create the lowest average balance, I create the most days with the lowest balances, right? Most days, lowest balances, lowest average. Well, that starts on day one. That starts now. If I want to create the lowest balance, I'm not going to wait 4 days to put any money in there, right? Because my balance is higher for 4 days. I need to go in now, right? And I'm not going to put some of the money in there to create kind of a lower balance. I'm going to maximize that decrease, right? And so that understanding leads into the first part of the strategy, which is anytime you receive money, it goes in the HELOC to pay it down. So instead of driving your income into your checking account, you drive it into the HELOC, which pays the HELOC down as fast as possible, as much as possible, creating the lowest balance affecting your average balance. That sounds crazy to most people because if you did that with your mortgage, your money's locked away, right? And people need to eat food and do other things to pay their bills, right?
But it's basically their checking account at that point.
Basically your checking account. So you got to pay your bills. Well, the great thing is money can go in and out freely here. So what you do is you pull from this. Well, that increases your balance, but you pull from this to pay for everything. This becomes your home's operating account. It's what your home uses to deposit money and to spend money. So now if we think about a 1 month cycle of that, I've got all my income going in, decreasing the balance as much as possible. Then I pull from this which increases my balance with my expenses. So decrease, increase at the end of the month from the income that you put in there, anything that you didn't take out for what you need is simply still in there, right? And it serves as principal reduction. So you've got your income principal decrease, expenses principal increase, and whatever's left over, whatever surplus you have at the end of the month is what pays down the house. So the only thing that ever pays off the house here is the surplus. So the only way this works is when there's a surplus. That's why I've kind of hit on like who this works for, right? It only works when there's a surplus, and the greater the surplus every month, the more it rewards that behavior.
Yeah, that's great. So really, a mortgage you'll pay the first of the month typically. With this, you're really paying the last of the month. Is that correct?
The money goes to you first. The money goes to you to pay down the principal first, and then at the end of the month, yes, the interest gets paid. Even from our bank standpoint, the timing of that is to your benefit. But that's a little bit more in the weeds than I think where we are in terms of this particular point of educational development, we'll call it that. So I can spin that a little different way to my benefit, right? But what it also means is by default, every single dollar of your surplus is dedicated toward paying down the home loan, is dedicated toward paying down debt. And if you're doing it correctly and efficiently, and there's no money anywhere else, there's no faster way to pay off the house. Everything is here. Everything is here, which means everything is dedicated toward paying off the house. Because there's no money anywhere else, there's no faster way to get that done. Now, again, that's in a vacuum, right? So I want to name that. There are other things and other pieces to life, but the way I like to teach this is I like to teach the strategy in a vacuum, so there's no confusion about this ideal, most effective strategy, right? And then after that, we can talk about, okay, well, what if I did this? What if I want to do that?
Yeah, no, that's good. And then compare that to a 30-year mortgage where I overpay it. You've heard like split your monthly payment in half and then pay it every 2 weeks. That's going to give you an extra month of payment, basically. So that will pay down your principal. How fast can that bring down your or pay off your mortgage?
So if you do one extra payment, I think it brings it down to 23 or 24 years, something like that. You can overpay. One main argument that we'll get, or sort of rebuttal, is, well, couldn't you do the same thing with your mortgage? Couldn't you put everything at the end of the month that you didn't spend toward the amortized mortgage? Which is fair. Mathematically, if you do that and treat them both exactly the same, the lower rate loan will outperform the higher rate. A couple responses that I usually come after that, because mathematically it's correct. However, for one, it's important to remember that this leverages everything. If I were to come to you, Kyle, and say, hey, I've got this strategy where you're going to be able to pay off the home really fast, and it's going to require for you to put every dollar of your surplus into a place that you can never take the money back out again, right? I don't know about you. I would not call that good financial advice. I'd call it pretty bad, right? And so the reality is the feasibility of leveraging everything is almost it's possible, but it would be a very, very unwise decision because now you don't have access to anything. So the main thing that allows for this strategy to be so easy and safe, we'll call it, is that everything you put toward paying off the home, right? Everything that's in here, if you need it, if there's an emergency, if something happens, you can just take it back out if you want.
Really?
Yeah, everything, right? So everything you put in here to pay it down, you can take back out, which that creates the security in terms of this whole strategy being feasible in a way that, even overpaying with your amortized mortgage. When I talk with people who do that, they choose a very small amount of their discretionary income to pay it down faster. They're very careful with how much they put toward that because it's not liquid. So the liquidity factor here, the fact that you have liquidity with everything you put in here, is really what is the big advantage in terms of that. Because what I find from a liquidity standpoint is initially when people start learning about this, they start on the, okay, awesome, I'm going to pay off my house really quick, right? Or reduce debt. I'm going to save a bunch of interest. And then all of a sudden you've got $300,000 or $500,000 in available equity that you can access today at 8%. So now that doesn't sound that high of a rate to me. Right. And so even if, this is not me advising you go leverage your equity. But what happens is it allows for people's heads to turn, their cogs to think like an investor, because they could say, what if I have access to 500,000? What if I took 100 of that and did this with it, right? What would happen? And unless you're a natural born investor, meaning you have that mindset, most regular people simply don't have they're not thinking in that way because they don't have access to enough money to invest and move the needle, right? And so it gives people the ability to start thinking like that, and that which can incentivize the shift in mindset from a debt payoff, debt reduction, get out of debt, and that's my checkbox, right? To I'm not really scared of debt. Let's dabble and see if I can make money, make more than 8% somewhere else, right? With 100 out of 5, right? So I'm going to leverage 20% of what's available. That's not that big a deal, right? So I'm going to do that. And if I can make 15% or 20% over here, and I can do that with relatively low risk, well, now I've got a way to move the needle in a wealth creation.
Yeah, that's pretty cool. So to your point,
different conversation, but
no, that's good though. I mean, so the mortgage, because I didn't really understand that actually. The mortgage is a black hole. Once you pay it, the bank's not giving that back. It's gone.
Unless you sell the house or unless you do a cash out refinance, no, it's a black hole. Yes.
So with this, you're saying that surplus gets paid at the end of the month, but that's just sitting in the HELOC. It's paying it down, but you can still access that if you really want to.
Yes. So let's think about that scenario we were talking about.
Liquidity is everything. That's awesome.
Liquidity is everything, right? So, we were talking about a $400,000 house with a line amount of $320,000, and you owed $200,000. If that person were to pay their balance down to $100,000, they still have up to $320,000. So you started out, you owe $200,000, you have access to $120,000, right? Up to the $320,000. Well, if they pay down that balance, that increases the amount that you have access to.
Yeah. Yep.
1-to-1 ratio. And so every dollar that you put toward this to pay down your balance, you can take back out. Well, if you take it back out, it increases your balance back, right? So that's the trade-off. But that's something that you simply don't have with an amortized mortgage just by the sheer nature of how they work.
Yep. No, that's making sense. Line of credit. You just got to think of it as a line of credit. That's what it is.
That's it. It is.
All right. Real quick, just on Legacy RX is my new brand, and I created this wealth formula that I think you'll like. And it really has to do with infinite banking combined with real estate investing. But I think it goes along with this very well. And the 4 L's I came up with for this Legacy RX wealth formula: liquidity, leverage, liberation from taxes and, multiplying your wealth. And then legacy was the 4th. I think those 2 things combined are, use those 4 L's, right? You could throw the velocity banking in there. And that goes along with all 4 of them as well. Because you're leveraging, your liquidity is huge.
Yeah.
Having access to that money, which we don't have with like a 401k or, to your point, your mortgage you don't have until you sell it or do a cash out refi. But then your amortization schedule starts again.
Starts all over, and you're giving the bank the majority of the payment. Yep.
There you go. So now the 80% interest is started over. That's great, man. All right, so just a couple more things, real quick. Like who should use this? Who should use this? Is it, can you use it for your primary home and investment?
I can't do investment right now. I can't do second home right now. If you ask me in a month and a half, my answer might be different. That's all I'm going to say about that. But right now I can only do primary residence. If people have an investment property, if you have an investment property and you were hoping to do it on an investment property, I understand it feels like there's less risk. The reality to me is that debt is debt. And debt structure is debt structure. We have helped people. One thing so I've got 3 loan officers on my team. All we do is first lien HELOCs. We do nothing else. I don't have a conventional. I don't have an FHA. I don't have a jumbo. We only have this, which essentially forces us to know this extremely well. And one thing that we can help investors do is run scenarios with our calculator to see what would happen if you were to pay down your current principal balance on your primary, but then use the available equity to completely pay off one of your rental properties. Well, what you're doing is you're transferring debt from one place to the other. You're not increasing your debt. You're increasing the debt on the primary residence, right, to completely pay off the same amount on one of the investment property. The reason why you would do that is that increases your cash flow. That increases the amount of income that drives down the HELOC every month, and it pays it down even faster than what it did before. So I've run scenarios with people where they've had 3 or 4 investment properties, and we've looped in investment properties at the point at which we have enough equity in our primary residence first lien HELOC to increase cash flow once. Now we increase cash flow twice. Now we increase cash flow 3 times. And at the end, they're paying off everything in that last go round in 3 years. So we can even simulate what it looked like from a debt reduction standpoint for a whole portfolio to be able to do that. At that point, hopefully I will have a first lien HELOC for investment properties. And then you can get HELOCs on those paid off investment properties, not for a debt reduction purpose, but for a leverage purpose. And so now you've got your debt reduction HELOC, right, on your primary, and you've got other HELOCs on investment properties to be able to leverage to grow if you want, or it can just serve as an emergency fund. I know that's a little bit in depth, if that makes sense, but so yeah, we can do that. We usually ask two main questions. One is, should you get this? And the second is, can you get it, right? When people talk with our team, we focus on the should you get this more than anything. Probably 2/3, maybe 3/4 of the conversation is about making sure that people understand the strategy. We do have a calculator where it's the one we used with you, Kyle, where we input your balance and your take-home pay every month and the total monthly spend, a couple other things, and then it basically shows us a projected outcome if you were to follow that budget, because the budget is the driver here. It's different. It's a different mindset, but if you were to be consistent with that budget, then you'd pay off your home in X amount of time. And our threshold for whether it's a good fit or not is 13 years. So if someone's tracking to longer than a 13-year payoff, we'll usually say, I'm not sure that this is the best fit for you, because at that payoff time, there's not much room for error. Because if you increase expenses by $300 or $400 or $500, a new car payment or something like that, it swings the loan a lot to make it so it wouldn't be a very good fit. And so that's our threshold. But so we hit on that, should you do this at the beginning? And if it's not a good fit, we will tell you that, and we will kindly let you move on, if that makes sense.
Yeah, I love that, because you guys are more about educating, enlightening people on this strategy, and it's really trying to help people. I mean, to your point earlier, you're trying to help people. You're not just a salesman saying, "Hey, this is for everybody."
Right.
It's awesome, which makes your life happier, which you can sleep better at night.
I can sleep very well at night, because whenever we talk to new loan officers, that's one thing that we always ask is, so this is going to be different, and if it's not going to work for them, we have the moral obligation to tell them and not try and get them into the loan. Because here's the thing, right? It's a line of credit that you can put money into, and you can take money out of it. When you take money out of it, it increases your balance. It works when people make more than they spend. Well, let's flip that. What if you have someone whose lifestyle costs more than their income, right? Well, I drive in $10,000.
You shouldn't buy a house at that point.
You should buy a house at that point, right? But, I'd agree, right? Or someone who isn't disciplined and realizes or doesn't realize, wait a minute, I can overspend for 3 years and it's not going to matter. I can spend $3,000 more. And when you do that, your balance increases, right? That's the opposite of what we want to happen. That is the absolute opposite of what we're here for. And so we do a lot on the front end from a vetting standpoint to make sure that people are good fits from a budget standpoint, from a discipline standpoint, an education standpoint. And when they're not, right, we just let them know, hey, look, I'm not sure this will be of benefit to you, right? It looks like the numbers here show a 25-year payoff, and you're going to give the bank $500,000 on a $300,000 home loan, right? That is not good. I don't think this is going to be of benefit to you. But then after that, we answer the, can you get it? Because when it works, people are like, holy moly, like, where do I sign up? It's like, okay, well, let's talk about a couple of things first, right? So in terms of that, I can do all states, but I cannot do Texas. I can't do Hawaii, Alaska. I can't do Maryland or New York State. So other than that, I can do all states. Primary residence only. You're going to want to have over 700. We can go to 680, but for the best terms, you're going to want to have above a 700 credit score.
Well, how about this? How about where can people find more resources? Could they reach out to you, or is there calculators? What do you got?
So firstlienheloc.com is a free educational resource, and that is a great place to start. I work in coordination with them. I've helped to write some of their content. They have a wealth of information when it comes to reading up on this and understanding how it works. There are a lot of people online, if you look up Velocity Banking, First Lien HELOC, that have done educational videos about this. Some will have you sign up and they'll charge you for a white glove educational experience, which is great, right? A lot of those companies need a bank, so they send people to us, right? When they have clients that they've taught. I would argue that we understand this as well as anyone in the country. I'm not trying to be arrogant. I really believe that.
Oh, that's good, man.
When you're the only fish in the pond, it doesn't really matter how big you are. But that being said, First Lien HELOC is a great place. At firstlienheloc.com in the right corner, there is one that says there's a button that says run your numbers. And that is going to be a really great place to, you can run the same numbers that we would run for you, right? That's a really good place to sort of see what would the projected payoff look like. Would it be good? Would it be bad? It'll tell you, hey, this looks like it might be a great fit. Looks like it might be a good fit. It'll say, this may not be a good fit for you, that kind of thing. And then there's another button in the top right that says sign up. And that's just to sign up for a discovery call with one of our loan officers here. The best thing to do, we can absolutely re-educate and fill in the gaps if we need to. But I always advocate for educating yourself on something first, right? And even running your numbers just to see if it'll be a good fit. Then at that point, I would book a call if you want to learn more, if there's still things you are confused about, or if you need it, to be retaught. And what they'll also do is they will rerun the calculator with you as well. We do that with every single person that we talk to. Because that is an extremely due diligence standpoint. That's an extremely important, step for us. And then if you want to get in the loan, we can help you with it.
Yeah, but I mean, to illustrate that with the calculations is the best thing ever.
It's super powerful.
Yeah, it really is. It speaks for itself, really.
Yep.
All right, dude. Hey, thanks for coming on, man. You are awesome. I've listened to you on some other podcasts, and I always learn something new. So
thank you.
I really love what you got going on. And so where can people find you personally?
I don't actually have like a social brand. I work at First Savings Bank, Rushing at fsbmortgage.com. If you want to get in touch, I'm the sales manager here. So I'm not originating loans anymore. So my role here is more to help guide the team, product development, that kind of thing. And sort of activities like this to try and raise awareness. So I'm happy to, again, I'm not off limits. I'm happy to chat. But in terms of one-to-one client-facing, kind of stuff, the 3 loan officers that work with me, again, that's all they do. They know this as well, maybe better than I do as well. So again, you're welcome to reach out. But in terms of having capacity and time to sit and and I'm not on the phone 8 hours a day. We'll just put it like that. But no, that's great. I really appreciate you, and hopefully we can put some links down below.
Yep, I will,
for people to take a look.
Yeah, we'll definitely do that. No, that's great, man. This is really cool. And the first time I heard you on a podcast, I think it was Chris Noggle. I was fascinated by it. I'm like, man, this is actually really, really cool. So I think a lot of people will get benefit out of this episode because it's going to be a new concept for a lot of people. So don't be surprised if we got some people reaching out to you.
I love it.
Or we might find you down in Nashville, on the Strip on Broadway playing the fiddle. So
hopefully at that point I'm playing on the corner because I've reached my goals and I don't need to. We're just doing it for fun. So we'll cross our fingers for that. But no, thank you so much for having me on, Kyle. This has been a pleasure. I'm really excited. So thank you.
Yep. Thank you, Anthony. We'll talk soon, man.
Sounds great.
All right. Bye-bye.
This is my time. I'm on the rise. Can't hold me down.
Thank you for listening. If you found value in today's podcast, please leave a review so our community can continue to grow. If you would like to stay connected or receive a copy of your free investing ebook, please go to www.sharpinvestmentsllc.com, and that's sharp with a P as in professional. This is not financial or tax advice. Please consult with your financial advisor or CPA.